This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So let's have a look at some further multiple choice questions just to give us some idea of how they look. Thomas got married on the 5th of October 2023 and his parents gave him £25,000 as a wedding present. His parents, plural, had not made any previous gifts for the IHT purposes. What is the total amount of the exemptions his parents can claim? Okay, so both of them have annual exemptions times 2 years, which is 6,000, and both of them can have the marriage exemption of 5,000. So that's 11,000 twice. So that's your answer. Okay, read the question carefully. Multiple choice question number 3. Kim died on the 15th of February 2024 with an estate of 245,000. She made a gross chargeable lifetime transfer of 98,000 in October 2016 and 118,000 in June 20. How much IHT is payable in respect of the chargeable estate of £245,000? And you'll see here from the model answer that the CLT in October 16 is more than 7 years, so there's no tax on that. However, the CLT in June 2020 is within 7 years of death, so needs to be reassessed to tax. Covered by the nil rate band, so there won't be any tax to pay. However, that will reduce the nil rate band that's available. Okay, so the nil rate band was thus reduced by the CLT to 207,000, which is then deducted from the death estate, leaving a taxable estate of 38,000, which is then taxed at 15,200. Now, in one of these questions, you might get a box where you've got to fill it in, or you might get an A, a B, a C, and a D, where A is 15,200. That might be 38,000. That might be 207,000. And that might be 245 at 40%, whatever that answer is. That also might be in there. Okay, so all of these things are varieties that you could get. So let's have a look at how that an exam question might look if you get a big section C question. So you might get a full question. Okay. Section C, you could get a 10 or a 15 mark question for IHT. It will come up, but it's more likely to come up as smaller parts than a big full question, because there are other things that they can ask you. They're going to ask you to adjust profits, either for sole trader or limited company. They are going to ask you to do a capital allowances computation. You will have to do an income tax computation. You will have to do a corporation tax computation, and you will have to deal with capital gains tax. Therefore, you're unlikely to get a big question like this, but I've given you this big question because it covers everything, and it brings the whole chapter together so that you can see exactly how these things happen. So you can use this as an example to work through. I'm going to read the example through, and then I'm going to show you the model answer. What you need to do then is to go away and look at this again, read through the chapter, and attempt example number 4 by yourself before looking at the model answer again. Use your BPP manual to expand your knowledge, because obviously this is just the basics we have here, and then to practice it with your revision kit. It will come up. You're going to get at least 10, if not 15 marks for IHT, because it's one of the major taxes. So Joe has died. He died on the 1st of April, leaving £250,000 to his wife and the remainder of his estate to his son. Now, at the date of his death, he owned the following assets: we have a main residence valued at 300,000, which means we need to consider the residential nil rate band here. Now there is a repayment mortgage on it of 80,000, so that needs to be taken off there, which brings it down to 220,000. Okay. There's a holiday home worth 140, some bank and building society deposits, a wealthy man 230,000, ISAs with 50,000, 12,000 shares valued at £20 each. You're going to have to do a little working with that. 12,000 times £20. Okay, you can either do the little working outside or do it in the computation. A life assurance policy, that was its value, but he actually received that. So you can see that's twice we've seen that situation. Ignore market value, it's what he actually received, because that money's gone in his bank account. Outstanding credit card bill, and he verbally promised to pay. Okay, that's not legally enforceable, so we can't have that. It also doesn't tell you any more detail, so we can't have that one, but we can have the funeral expenses. So that's what the estate looks like, basically. That's copying out the estate. Now, unfortunately, the guy made some lifetime transfers, so we're going to have to do stage 1 to work out what those lifetime transfers were. Then we're going to have to do stage 2, the additional tax on death. Prior to doing the estate, I would start with the estate, but this is obviously workings we need to do. A pet to his son on the occasion of his wedding. Okay, so we're looking at a 5,000 plus 3,000s there, coming off that, and it will be covered by the nil rate band. So as a pet, it won't have lifetime tax or tax as a result of death, but we need to discuss that obviously. July 18, transferred 405 into a trust. He paid the tax, 25%. That's a CLT. And December, he gave 4,000 shares to his son. Prior to the gift, he owned 16,000 of the 20,000 shares in the company. And these are the figures. We're going to have to do diminution. Okay. Calculate the amount of IHT payable in lifetime and upon his death. Okay. So let's have a look at the model answer for this. And I would be tempted to do them in the order in which we have discussed them in the chapter. You may wish to do the estate first because that's the easier bit, in which case you could show that clearly and then work out the lifetime tax and the tax due as a result of his death as a working. As you progress with your knowledge of IHT, you can decide whether you want to do step 1, step 2, step 3, or whether you want to start with the answer and then do workings. The more you practice, the easier it will become to decide one way or the other. So we're going to do it step 1, 2 and 3, simply because that's the way we've done it in the chapter and it will obviously make more sense. So these are the lifetime transfers. Again, we have the dates and what kind of transfer it is and the values. Now this pet here was the shares, so we'll come back to that one in a moment. We'll do them in the order in which they came. Do you remember the original pet? That was to his son on the time of his marriage. So we've got a marriage exemption, current year, previous year. Make sure you get the dates right, which means £29,000 of that pet is potentially taxable, but obviously it isn't because there is no lifetime tax. The CLT. We can have the 1819 annual exemption, but we can't have the previous year 17-18 because it's been used, and that's going to be chargeable. We're going to have a look at that in a moment. And obviously the pet is no lifetime with the annual exemptions for 22-23 and 21-22. Let's have a look at that working first before we move down. It's diminution, the transfer of value diminution. Right at the beginning of the chapter, we looked at before and after. So before, he had 16,000 shares, which from the question we can see are valued at £25 each, giving us a total of 400,000. After the transfer, he only had 12,000. And again, the question gave us the value of those, and we did a calculation to come to 216,000, giving us a diminution or a transfer of value of 184,000. Clearly label up that it's a working and give it a title, and then obviously your working, clearly label in your answer that that's how you've come to that, so that the examiner can see. Because if that 184 is right, then the examiner, the marker, will only give a cursory glance down to your calculation and give you full marks for it. If it's wrong, he needs to know why you haven't got it right. It may be that you picked the wrong value. It may be that you did the wrong number of shares. It may be that you missed your finger in the calculation. He can then give you marks. You understand diminution. You knew it was before and you knew it was after. If there are 2 marks for that and you made 1 error, you may get 1.5 marks for it. And that's what's so important. Show every single calculation. So let's work out the tax on the CLT. It has a nil rate band which has not been utilised anywhere else. So that covers the first 325,000. So the balance of that gift of £402,000 is 77,000 at the rate at which he is paying, because that's 25%, and £19,250 is the amount of lifetime tax paid on the 3 gifts. Okay, now the guy has died. So what we need to do is to work out now how many of those gifts we've got to pay tax on. So I'm going to redraw that out again so that you can see. He died on the 1st of April 24. Take it back 7 years to the 1st of April 2017. Draw the line in the sand. Now the pet was in November 17, so in that case then all of these, the CLT which was in July 18 and the pet which was in December 22, all of those are now going to come into charge, and all of them need a 7-year window. This is now taxable, this is now taxable, and this now has additional tax as a result of death. So let's have a look at how that's going to work. We're going to have to redo all 3 computations. Step 2, additional IHT as a result of death. So the first one, the pet, there won't be any tax on that. That's going to be covered by the nil rate band. But that is going to have an impact when we do the second one. So when we do the CLT, that nil rate band of 325,000 will be reduced by the 29,000 of the pet, leaving £296,000 of nil rate band taxable at 0%. Now the gift, the gross chargeable gift, was 421,250. So the balance after the nil rate band of 125,250 is taxed at the death rate of 40%, giving us tax of £50,100. Now there is taper relief available at 60%, so that's reducing that 50,000 down to 20,040. Now we paid some tax. Go back just to confirm that we did. Where's the confirmation of what tax? There it is. There's the confirmation of what tax we paid. We paid £19,250 and we can deduct it from there, leaving an additional tax of just £790 payable. The third gift, there is now no longer any nil rate band left. There's no nil rate band left. It's all been used. So the whole of that pet is taxable at 40%. £71,000 worth of tax is due. So if you are giving a pet, you make sure, let's go back to the question said that it had gone to, let me just check where it had gone to. Yeah, it had gone to his son with shares. Now, those shares, he may have to sell them. He's got to find £71,200 worth of tax. The revenue don't care that it was shares. They don't care that he'd lost his dad. They don't care. They want £71,200. So he will have to find that some way or another, perhaps sell the shares. So when giving gifts, make sure that the individual is aware that if you die within that 7-year period, then you will have to pay the tax. That takes us then to stage 3, which is the estate, which again, we have a residence less a mortgage we looked at the time. All the various different items. We had a holiday home, some bank interest, an ISA, the shares with the calculation which we discussed when we looked at the question, and the amount of received, not the market value, for the life assurance. All added up together comes to over £1 million. We have the debts and the funeral expenses, not the medical expenses. They're not legally enforceable. And 250,000 has gone to the spouse, leaving £758,000. Now, the gross transfers in the previous 7 years have used up the nil rate band. However, we are entitled to a residential nil rate band, leaving the balance. So those two come to 758,000. And the balance after the nil rate band is taxable at 40%.